Good afternoon, YouTube. Stocks by the numbers here. Welcome back. Wanted to do a quick video here as per request. Name of the company in question, NIO Incorporated, ticker symbol NIO, listed here on the New York Stock Exchange. Company pulled back here, now down below $8 a share, $7.92 here on the day, down 33 cents and even 4%. And as we see, more importantly, we're kind of here near the low of the 52-week range, potentially with the potential of making new lows here. But I wanted to check the numbers, I wanted to check the charts, because I know, of course, this is an EV company. However, they are out of China. But regardless, as we see here, like we saw with so many other EV companies, as soon as the stimulus money came in, you had this no-name stock that was probably overvalued from date of inception, in my opinion, and it absolutely exploded, going from $3, $4, $5, and everyone took it up to $67. So yeah, obviously, regardless of what the heck is going on, the stock was going to crater down, and that's basically what we're seeing here. So this is a 5-year chart. This brings us back to about the second half of 2018 when the company began trading. And I just wanted to point out a couple of technicals before we move into the fundamentals here. And first of all, as we can see here, there's a gap up here. I'm looking at a 5-year chart. So here, wait, hold on. There you go. See? So if I zoom in there on a 1-year chart, you can see that gap up right there from basically where it's trading right now. It was about that 796 level, and the stock chunked down from, the stock chunked up from this current level here, and then opened up at $9. Okay, so there are some positives and there are some negatives. However, on the technical side, it has been looking kind of rough here. I went from these lows here all the way back in 2019, and even if you extend this blue trend line here back up here a little bit, basically it was forming a symmetrical triangle. Now, I know I didn't review the stock during that time frame, but honestly, like I said, sometimes when it's unclear or undetermined, in my opinion, sometimes I like to draw out my trend lines, keep an eye on any potential patterns. As you see here, I have NIO on my watch list, and I just wanted to see how this thing played out. So here, again, we had that symmetrical triangle, which again is not definitive of a bullish breakout or a bearish breakout. However, it broke down below the bottom trend line and began to pull back, hence this red arrow here. Now, going back more importantly to these lows here back in March of 21, and then that immediate high there in July of 21, you'll see these orange trend lines that I drew out, which is basically a long-term trumpet pattern, which again is undefined whether it's bullish or it's bearish. But again, these are a few technical patterns and a few resistance levels that the stock really has to get back to. So this is why I kind of drew all this out for you guys. So even over here, you can see another gap up as well. So that's why we have multiple gaps there. And at the base of this candle is where I drew this line here. It looks like maybe about 10 3/4, like 1076 or something like that. And if I zoom in even more, so here's the break coming out of the symmetrical triangle, and you can see the bounce here off of this level looking like, what, about 1480 maybe, and then, boom, we gap down right in there in that circle. I'm sure you guys can see that. And we gap down here and just began to break. And basically, like they say on technical analysis, gaps always fill, right? So we are in the middle of a potential gap fill here, back up into the high 8s, and then, of course, potentially back up to like 10.5, 10 3/4, and then we have the potential for another gap up here north of 14.5, 14 3/4. And this may actually work out favorably for anyone who wants to go long on the stock, because again, I know that it could be viewed as overvalued still, because I understand the company is struggling. However, if we look at the revenue here and the numbers coming in, struggling on the profitability side, however, the revenue here, $1.3 billion up to $1.5 billion, maintaining $1.5 billion for multiple quarters in a row here, 4 quarters in a row, and then jumping up to 1.823, even though they came in light on those estimates. But now next quarter, surprisingly, is 1.7. So, this is what makes me laugh. These companies to begin with are overvalued, and then when they begin to struggle, the analysts, lower their expectations and try to give the company like a freebie, a layup, if you will. And it's just interesting because if you look at the reported EPS here, about minus 17 cents a share, that moved up here to minus 12.5 cents and then back down to minus 20, reported almost minus 30 cents, reported minus 44.5 cents on 2.3 billion. Look at that, missing estimates by over $150 million, over a 6% miss on the revenue side, right? So revenue's growing again. We showed maintaining 1.5 billion, jumps up to 1.8, even though they missed those estimates as well, and then jumps up to 2.3, missed those estimates as well. And now look at this. Now somehow the EPS is going to rise from this quarter, where they brought in 2.3 billion. They lost 44.5 cents a share, but somehow bringing in 1.7 billion, they're only going to show a loss of a little over 38 cents a share. So first of all, in my opinion, we're going to look at the numbers, and I feel that they're probably they should technically report lower than this, especially if they're coming in with like 20-25% less revenue than they posted the quarter before. So a situation like this, everyone was hyped about, because just like with every other EV stock, everyone says to themselves, well, once they start making money and pumping out vehicles, they're going to go to the moon. You know, they're going to be backlogged. They're going to have orders for months and years, and the revenue is just going to consistently increase quarter over quarter, year over year. Well, again, I understand that everyone wants to stay positive on a situation like this. However, seeing back-to-back misses here, even though revenue increased, but then somehow going from 2.3 billion down to 1.7, in my eyes, I really view that more as a negative as opposed to a positive. Now, again, I understand estimations are low that are giving the company a leg to stand on, so to speak, to potentially pop out and get back to some of these old support and resistance levels. However, if we look at the actual numbers here on the stock, you can see we're trading right now market cap a little over 12 billion. Company's losing over $1.25 per share. Look at that float, 1.5 billion shares, crazy. And we can see here over the last several quarters, you can see the losses widening severely. I mean, you know, obviously they had a good quarter here, random Steam friend. We had a good quarter here on the EPS side, and then a slight miss there on the profitability side, and then we just began slipping like crazy here, posting, as we see here, misses north of 60% to the downside. So the company has to increase their efficiency or their productivity somehow and try to limit this bleeding. Otherwise, it's really going to be all for naught. And as we see here, you can see back in 2018, the company was doing less than $1 billion in revenue. Then it jumps up to north of $1 billion, north of $2 billion, over $5.5 billion. Last year for 2022, $7.32 billion. Yet surprisingly enough, going from $2.3 billion to $7.3 billion, they are now losing more money than they were bringing in 30% of current revenue. So this is what I'm saying. This is what always throws me for a loop here with these stocks, right? Because we kind of saw this similar move here happen with Tesla over the years. And once Tesla made that big jump and all of a sudden they were bringing in multi-billions, the company began to get closer to net income positivity. They were narrowing those EPS losses, and then they turned net income positive, and that's what really helped bring the stock to the moon. Plus, they consistently beat earnings estimates. We have kind of the opposite here. We have a company that apparently they're losing money on every vehicle that they're making. So even when they came out here, we can back up. You look at a 1 month here, you can see May 1st, it was right around here, right? So the stock was, I don't know, we'll just call it high sevens. And that's when they said that, oh, deliveries are up 30% from the time they were last year. And you saw the short-term pop up to 8.5, and it kind of hung out at 8 for a little bit, but now you can see it's pulling back, and now it's sub 8. So, again, it is a positive catalyst that deliveries are up. However, apparently, Wall Street analysts and traders are all viewing that as a negative, because what we're seeing here is apparently the more vehicles that you make, the more money that you lose. So I don't know what they're doing over there, and right now they're just exclusively selling in China. And if you guys recall, I remember I don't remember exactly what happened. Maybe it was with that Chinese real estate situation or something. I don't remember, but I remember making a video several months ago, and we discussed a Chinese company. I think it was Baba, actually. And, I basically said, in my opinion, I would stay away from Chinese stocks. And as we see, of course, over the last several months, pulling up a 6-month chart here, you can see something like NIO has just been in a massive downtrend. So if you did by chance happen to listen to my advice and not get involved here, you can chalk that up as a win, right? Because you'd be down probably 40 or 50% by now. However, the fact that the company is located in China and is solely selling its vehicles in the Chinese market, but yet somehow is losing more money the more that they make. And of course, the last time I remember the Chinese regulators were like withholding some data to the American regulators or something. I don't remember exactly what's going on, but in my opinion, I really wouldn't trust a Chinese company right now. Well, specifically a company that is solely in China, because again, this company, 100% of its revenue is coming from China, right? You look at a different company like Alibaba, and obviously they're a little bit more international. They have, good revenue coming in from overseas and whatnot. So, they're more exposed to the entire world. And NIO, for all we know, the company could have made $1 billion last year, and they're just posting $7 billion. I have no idea. However, the one thing I do know is, again, switching over here to the quarters, as we see, as revenue increased from over $1.5 billion to 1.9 to 2.2, the company's profit margin and losses began to extremely get out of control, in my opinion. And right now, again, I see the 1-year price target here, 13, and I wanted to show you guys as well, as of late here, you can see I kind of drew these purple trend lines, and you could say we're potentially in the middle of a descending wedge, which technically is a bullish pattern. And right here at the apex, incidentally, is next quarter's earnings here, early June here, June 9th. And again, estimates are pretty low. So if they're giving them a leg to stand on and NIO happens to come in with some positive numbers and beats these earnings estimates, that's going to add to the catalyst. That's probably going to propel the stock here from the low mid sevens probably back up to this support level right here of like the 10 3/4 that we pointed out. And again, you see the bounce off this level here. You see multiple bounces here, and here, and here, and here, and here, and here, and here. So this will most likely be the level that the stock will try to get back to, roughly 10 3/4. So in my opinion, we do have the potential to make about 40 or 50% here on this NIO trade. However, they may bring it down here to the fib and the bottom trend line of this wedge, which as we see here is roughly $7.19. So we do have the potential to have a pullback here over the next couple of weeks, because again, June 9th is about 3 weeks away, right? So you still have time for them to bring it down to the bottom of the range, bring it up to the mid-range, and then right at the apex potentially break it out on the earnings estimate. So if you like NIO, you like the story, you believe in the company, and you think these estimates are a little too low, I understand if you want to take a long position here in the near future or potentially step in, buy some calls, a month or two out, and try to catch that pop. Totally understandable. However, again, the numbers are absolutely dismal. So, there really are no guarantees here. If we look at the cash flow here, the company obviously struggling here on the cash flow overall. However, cash from investing activities has turned positive here, roughly $1.5 billion. The assets have been growing. However, the liabilities are up, again, almost a 40% pop from where they were in 21, now sitting here at 22. So the good thing is the assets are still outweighing the liabilities. However, it's becoming a closer and closer ratio to break even, which of course is not really a very good sign. Right? For example, as you see here, the liabilities were outweighing assets back in 2019, and then moving into 2020, you can see, look, assets more than a 2-to-1 ratio there. And even moving to 2021, it's a little over $6.5 billion, which would be half of 13, right? But they're still basically 2-to-1 ratio. Now you're at 14 billion to 10 billion, which is roughly, if you cut that in half, that's a 7-to-5 ratio. So that is no longer as favorable as it's been in the past over previous years here as they were growing. So now that they technically got bigger and got more assets under their belt, and revenue has now jumped up to 5, 6, 7 billion, apparently they're taking on more and more liabilities, which could spell disaster for the company down the road, but obviously it all comes back to revenue and if they can increase efficiency and lower cost, of course. They have a couple of $1 billion in debt on their balance sheet, and look at the book value per share here, sitting at $2.27. Right now the stock's at $7.90. This is why I point these things out, because if the market completely shits the bed and the shit hits the fan and everything starts to crash all at the same time, there is really no reason as to why this stock should maintain these 7 or even 6 levels and could easily pull back to 4 into the 3s and get closer to this book value. Because again, we've looked at a lot of other stocks that are healthier financially than a company like NIO, excuse me, and they're only trading, a couple of times book value. And here, as you see here, the company's trading, what's that, like 3.5 times book value or something. So that's why the company does have the ability to continue to slide. However, with that descending wedge that we looked at, and of course earnings coming up in a few weeks, those could be your catalysts to show a little bit of a breakout here. But look at these numbers here. So total revenue for 22 was 7.3 billion, about a 30% jump in revenue from the previous year. Fantastic. But look at the cost of goods sold. The cost of goods went from over minus 4.5 billion to north of negative 6.6 billion. That's about a 50% increase in cost of goods sold year over year, right? And of course, cost of goods sold is up 200% with the increase in revenue. Now that's understandable. However, it's the operating expenses also that are really beating up the profitability of the stock. As we see here, basically just like the cost of goods sold, operating expenses went from sub minus billion, doubled up to minus 1.7 billion, and then basically doubled again, now sitting here at minus over 3 billion. So this is why, again, the total revenue minus the cost of goods gives us our gross profit. Our gross profit minus the operating expenses gives us the operating income. And as we see here, the operating income is absolutely dismal. So this is why, again, I understand people jump on these companies. They're cheap. They're only a couple of dollars a share. It's an EV stock. They might end up being the biggest in China. Like, I get it. But just remember, you have a company that looks absolutely terrible here in the fundamentals, in the numbers, but yet for some reason y'all took the stock from $4 or $5 to $60, right? So this is what I'm saying. This is why when I see high flyers like this happening for no reason, I just sit back. And if I have the liquidity, I wait for them to top out. I wait for them to hit astronomical valuations. And then I simply push the buy button and step in on the put side or on the short side. And it's like shooting fish in a barrel, right? Because there's no way a stock goes from $5 to $60, $70, just because, it was 2020 or whatever the heck happened. So as much as everyone watching the video may want to deny this, at the end of the day, young people got stimulus money and you all bought the same stocks. So you all pumped each other's stock up and now you're all going down with the ship together. And it's really a shame. It breaks my heart. And again, I've been down that road. That's why I began making these videos, to not only point out any potential technical patterns I might see or any rises or consistent drops over the years in the fundamentals, but more importantly, because I've made silly decisions like that, not analyzing the stock and just going in. And I'm telling you, it really ends up biting you in the ass. And if you turn around and buy at the wrong time, and a year or two later you're still locked into a stock, and the position is still down 70, 80, 90%, as much as this sucks to hear, unfortunately, you really only have yourself to blame. So again, on paper, the company looks absolutely dismal. We'll switch over here to the statistics. There is no PE because the company is bleeding like crazy. Price to sales is now sub 2. However, again, 25 times sales. I mean, this I wouldn't use as an indicator at all. There is no cash flow, so there's no price to cash flow ratio. Again, over 3.5 times book value. We've seen healthier companies not trading at that ratio. The enterprise value, again, what a company would supposedly offer to buy out the stock here. And this is what makes me laugh. You see how the enterprise value absolutely exploded almost 1,000% going from 2019 to 2020. Why? Because you guys pumped up the stock. And as you see here, prior to that bullshit rally, the enterprise value of the company was only several $billions. And yet it jumps up to north of 50, stays over 40, and then somehow craters down 70% to 14, and now it's sitting here at 10 billion. So realistically, it's probably like this number. Right? So this is what the company's worth, probably in my opinion. Probably between like 4 and 6 billion. So it has a market cap north of 12. They're saying the enterprise value is north of 10. However, this enterprise value is bullshit, as we see here, because the company wasn't doing a tenth of the revenue that they're doing now back in 2020. And look at the enterprise value, the way it exploded with the overall market cap valuation of the stock. And if some company stepped in and offered 50, 60 billion for NIO back in 2020, I would have laughed my ass off. Imagine buying a company worth like 3 or 4 billion, but you pay 50 billion for it. That would, man, you'd get fired for that one. I'm going to tell you that much right now. And we switch over here to our profitability ratios. We have our return on assets here, basically maintaining like this minus 15% level, nothing to write home about. The return on equity was climbing here up to negative 34%, and then, of course, cratered back down, sitting here at minus 48%. Same thing on the invested capital, was climbing up to about minus 26%, since pulled back, sitting here minus 32%. The gross margin percentage, we looked at these numbers before, the gross and the operating numbers, and as we see here, climbed all the way up to north of 17%, and then dropped by about 50%. And dropped by over 50% again, going from 8.75% now down to sub 4%. So this is what I'm saying. This company is seriously bleeding and struggling. And again, unless you see a breakout quarter here coming up in June, I personally would not be a buyer here of NIO. Operating margin, again, was up to less than minus 13%, and then tripled basically back down to minus 33%, now sitting minus 43%. EBITDA, once again, earnings before interest, taxes, depreciation, amortization, one of our main metrics. The company was rising from the huge negatives, got up to minus 6%, phenomenal, and then drops that by over 300% back to minus 24.75%, where it's currently sitting right now. And we looked at the profit margins again over the last several quarters, have just been completely dismal. However, over the years, got up to minus about 29.25% and has since been slipping from those highs, minus 29.5 now, sitting at almost minus 36.5. So that's why you do have low expectations here for this quarter coming up. Again, I will reiterate that. So you could see a pop with the technicals here, the descending wedge, and of course strong numbers coming in. But honestly, if I had the liquidity, this is something that I just wouldn't get involved in, because there are no guarantees. The book value is $2 a share. It's at 8. It went to the moon for no reason, so now they're bringing it back down all the way to the ground, and the company continues to struggle here. And again, even on that news announcement of deliveries up 30%, yeah, you saw a quick little pop there, and it tried to hold that $8 level and has since broken. Right? So if that was really good news, that was really going to impact the value of the company 6, 12 months, 3 years from now, trust me, they would have brought the stock above $8 and it would have maintained the high 8s, the high 9s. And obviously, that is not what is happening here. The asset turnover has been slowly increasing year over year. However, again, even though assets have been increasing, we did discuss the big negatives there with the huge increases in liabilities as well. So I don't know if I would really use this as a positive indicator as well. And of course, they have inventory. They have inventory to turn over, right? So this stat is very interesting because you can see over the years it absolutely exploded, going from 3.6 to 6, almost 7, doubling almost to 13.6. Look at this, north of 17.5. And then drops by 50% down to 8.3, now sitting at 8.1. So this is what I'm saying. I can appreciate the fact you might like the idea. Maybe you like it because it's a beaten up Chinese stock. Maybe you like it because it's an EV company. I can appreciate all that. Random motorcycle going by. However, I really cannot see any positive metrics here on this company. The best thing going for the company is the tech pattern that we pointed out, the descending wedge, and of course low earnings estimates. But switching over here, look at this. This is interesting. So now the forecast for the stock over the next several years looks to be favorable, but think about this. The company rose up to north of $7 billion, again, as we see, coming in below analyst expectations for the year. However, they're bleeding like crazy off of this $7 billion, right? Now look at this. It's showing net income positivity on the EPS side for 2025 here, estimating 14 cents a share for the year of 25. Look at the revenue estimates. $21.34 billion. So you're telling me revenue has to triple from its current point before you're slightly positive, right? Think about that. So what that tells you is if these metrics are going to stay dismal for the next 2 to 3 years, if the company is going to continue to bleed and post these sporadic, irregular, inconsistent earnings, then there's really no urgency here. There is really no urgency here. There really isn't. I promise you that. And obviously, anyone who's been holding for a while, I understand, again, earnings are coming up. We have our tech pattern, so you're hoping for a pop so you can, potentially get out or make a couple of bucks. I totally understand that. I hope everyone watching this video, no matter what side you're on, makes millions of dollars. I say that all the time, right? So don't try to jump down my throat there if I say that a company really, at the end of the day, kind of looks like a piece of shit. Because I just call it like I see it. So, like I said, right here at $7 billion, and now you're saying for this year you're looking at almost $12 billion. However, the company just missed earnings, I believe, on the revenue side, right? So now it's going to be even harder for them to hit this forecast number for 23. But again, you're telling me, look, they reported 106 on estimates of a loss of 98 cents a share, and now they're estimating a loss of $1.01 still, right? So losses are going to stay the same, even though revenue is projected to increase 50% from the low 7 billions to almost 12 billion. I mean, you understand what I'm saying? It just doesn't make sense. It doesn't make sense. And I can appreciate the fact that all these companies get listed, go public, and collect billions of dollars from people like yourself so that they can increase their productivity or pump out their product or their services ahead of schedule. But at the end of the day, again, if we were running a company here and revenue jumped from 5 to 7 to 12 to 16 to we would be profitable. We would be profitable. Because regardless of what anyone wants to tell me here, if no matter how much money you bring in, you're losing $1 plus for every dollar you bring in, then it's really not a sustainable business model. So again, to reiterate, the only real reason as to why this company exploded and got on everyone's watch list was because young investors got free stimulus money from taxpayers and then pumped up these useless, no-name, overinflated companies. So, again, I know I'm getting a little rough, I'm getting a little abrasive here with you guys. However, you can see, at least 80, 90% of the companies we look at all had the same move there, the mid-tail end of 2020. And no matter how much you like the stock and want to tell me it's going to fly to the moon, just remember, y'all pumped it up to $50, $60, almost $70 a share. And if it was really worth that, it wouldn't be down 90% from those levels, right? So just keep that in mind. That's what I always try to say. Simple logic and common sense sometimes cuts through all the bullshit and gives you the clear-cut picture of what's really going on, what's really happening here. We can see on the EPS side, missed 4 of the last 5 years. Again, revenue increasing. But again, look at these forecasts, the way they're expecting this company to pump up the revenue year over year. And then right as they really start to bring in the revenue, they miss estimates for the year of 22. So, again, I'm really not seeing a lot of positivity. I'm glad some of these numbers are increasing year over year, but again, as we see, all of the business is coming out of China. So I don't even know if we can trust these numbers. I have no idea. However, to flip it over to positivity, to end it on the positive note, again, we have a descending wedge with the apex coming in right at earnings. And if that does happen, it will potentially rally into earnings, might even break out of the wedge going into these earnings. And you may have, again, a pop-up here to about the 10 3/4 level. And for some reason, if price targets get raised, even though they shouldn't, after this company comes out with a good quarter, who knows? Because it's a cheap, high-flying EV stock that a lot of kids play and trade in, it could potentially rally up to 15. Who knows? Should it happen? No, absolutely not. Will it happen? Well, I have no idea. Again, if you told me at this point here, oh, have you seen NIO? It jumped from 4, now it's up to 6, it's up to 7. I would have said it's not supposed to be. And then you would have said, wow, look at NIO up at 13. It's not supposed to be. 21, 40, 60, almost 70. Yeah, you know what I'm saying? So this is what I mean. When no-name companies with shitty revenue begin to fly, don't worry about the FOMO. Seriously, don't worry about it. Just wait, be patient, keep it on the watch list, let these schmucks take it all the way to the moon, and then jump in like the smart money does, and get your guarantee sell-off. Don't worry about the run-up. Because again, you don't know where it's going to go. At any point on this rally, it could have reversed and started dropping 10-20% a day, and it would have been 110% justified. So you don't know where the rally is going to go and where the top is. So you're better off just hanging out, and then when you see an astronomical price like that, that's when you hop the fence and go on the other side. Switch over here to stock charts real quick before I let you guys go. This is annoying. As we see here, look at the MACD, look curling and potentially about to cross and head towards the downside. We have the bottom Bollinger Band of 746, and I did mention the bottom here of this wedge by this fib of roughly 719. So we could have a pullback before we have a rally up. The 50-day moving average is sitting here at 871, right near the top Bollinger Band, but I really don't think it's going to get there anytime soon. It will most likely go down before it goes up. And see what happens when you pump a stock up, because now on the daily you have a 200-day moving average at 1239 when it should be like 839, right? Such a shame. Switching over here to the weekly, you can see RSI sitting here at 38.4. However, it has dipped down on multiple occasions. However, it did bounce off that 30 benchmark. So, again, keep an eye on this. Bottom Bollinger Band 683. That seems a little low, but if they do continue to crater it down, if this RSI hits this, about this 30 benchmark here on the weekly, I would potentially start to piece my way in. But, of course, we would have to reevaluate the situation. MACD looks relatively flat, may potentially cross again. And, of course, again, this is why you don't pop up and pump up useless stocks, because the 200-day moving average is north of $21 when it should be like 10. So, yeah, I don't know. You know what I'm saying? I don't know. Like, I get the story. I know everyone likes cheap EV stocks. Like, I get it. But to be blatantly honest with you, if you all watching this video sent me all of the money you could, and all of a sudden I had thousands, tens of thousands, hundreds of thousands of liquidity to take an investment and take a position, guess what? NIO wouldn't be it. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you all for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Just like everyone on YouTube says, like the video, thumbs up, algorithm really helps out. Everything that YouTube works off of is off the likes. I don't know. So just push the like button even if you didn't like it. Subscribe to the channel if you appreciate the content. Obviously, I love seeing my community grow day after day, week after week. But moving forward, like I always say, I understand that markets are rocky and they're volatile and they're very uncertain. So I want to wish everyone success. I hope everyone makes a couple of dollars. Thanks for stopping by. Catch you guys in the next video.